This is Martin from Secrets, the channel for learning about trading and investing. Welcome to 2022 yearly stock market review. First of all, subscribers and those who are viewing this video, wish you a happy New Year 2022. And I hope you had a wonderful trading journey and investing journey in the last year 2022. And even if you had not that, I wish you luck. And every learning and every improvement in your mindset regarding trading and investing would be would be confirmed that you would be profitable in the next one if you even if you had some losses previously. So let's get into the Nifty 50, which is the primary index that is used for analyzing performance of the market in the market. And you can see that 2008 was a 4% return, 4.3% return. But that is much lower than the previous 4 years, 3 years, 1, 2, 3, right? It is a 12% 2019, 2020 the COVID dip and uprise 14%, and then 2021 the money printing foreign inflow of money 24% up. So 2022 the inflation came in because of oversupply and measures of controlling that came, money has pulled out, and then we have 4.3%. So it was the worst performance the last 3 years, but obviously that's understood after the COVID crisis that happened. And if you see that there was only one instance in 2015 and 16 and the entire last 20 years wherein you had two multiple years of consecutive underperformance, and therefore we can expect that in 2023 could be hopefully providing much more return than what it had, at least double the kind of return that that it had given in 2022. Historically, let's just be hopeful, because it had happened only twice that you have 2 months of underperformance in the last 20 years, as I said before, right? So it was very volatile 2022 basically. Although we gained 4%, 4.3%, it dipped 9% from the top in the same 2022, and it shot up 8.2% from that dip, and finally it ended up having 4.4%. That's so it is a volatile 2022 after the money that flowed in post-COVID crisis handling, and after the money started getting pulled out. No, that's what I would define volatile 2022. So looking at the different sectors in the industrial structures, you can see that 4 of the sectors did well. Banks did well, of course, 13% up. Metal 23% up, price moved 23% up. Metal index we're talking about. FMCG index 21% up year on year. We're talking about. Banks is at 13%. Auto 7.5%. So what brought the market down, where the money is taken out, is the IT index. 18% of pullout has happened. It has degrown 18% from the previous year. So what could the same is reflected in the Nasdaq, the primary index of the used indices where the IT stocks are concentrated. So that has also substantially got pulled down. So that's the primary reason for that. Pharma 4.5% and 10% down on the reality, right? So pharma, realty, IT, the 3 sectors that underperformed, and metal, FMCG, banks, and auto not performed. So highest outbreak has happened in the metal, probably because of some China comeback and the recent China comeback, and the steel industry related concentration is on the Chinese market. So that could be the reason. And when the markets opened up, FMCG shot up. That's where the consumers go out to the market and they buy things. Auto, when the roads are open, the lockdowns and quarantines are over, auto manufacturers comes into play, and then people start buying and start commuting more, and that's a 7.5%. That's all the sectorial performance after 2 years of COVID crisis ended up in the market. Now, the industrial heavyweights, we're considering only the top 7 heavyweights for the largest constituent of the Nifty 50. If you see how they performed, is look at this. So the highest up was happened in ICICI Bank. Then HDFC Banks also did. HDFC also did. Reliance also did 6.5%. So these are the 4 stocks that brought the markets, pulled the markets up, right? So it was primarily the banking, the HDFC and ICICI Bank are enough to pull the markets up, hold the markets up, at least that much. If If the bank was not doing well, then now markets would not have been as resilient as we have been talking about, right? But the IT, look at the IT heavyweights in the index, Nifty 50, Nifty and the DCS, both of them 13% down, and Kodak Bank was flat kind of thing. So that's how the industrial sectors performed. The heavy constraints of banking made it possible to hang on along with Reliance, banking and finance, basically, right? So look at this. This is interesting institutional participation, right? So we had a big money printing that happened after the COVID crisis, and money started plenty available with the institutions, and then that money obviously flowing into our markets, and we had a pullback from the swing low of the COVID in 2020. So that continued, and we had a volatile Nifty 50 was buying and selling happened, swing low and swing high. All this happened, and net to net it was minus 1657 crores of selling that happened from the institutional side in the cash market. Affairs saw 2,78,275 crores of selling in the cash, and domestic institutions held the market. So it was the domestic institutions which was primarily buying, and it was all selling by the institutions that happened in the entire 2021. 22, I mean, right? So that's institutional participation. So going forward, the selling may not be this intense because the inflation is getting cured, and various measures are being taken, and then slowly it may go through some recession phase, and then eventually 2023 itself it should come back, and then money should flow back slowly again, is what we can look forward from the institutional participation that we're seeing. Global indices, if you see, Dow Jones was 5%. Across the globe, it was down. It was not up anywhere. It was only our market which has done at least 4.5%. So we have outsmarted the entire global market, you can say. We'll continue to do that in 2020. That's another story. But look at this, Dow Jones 30 is 5.5% US index. Nasdaq, Dow Jones is primarily just like our Nifty 50. Nasdaq is primarily fintech companies, 27% down. That's what our IT stocks. Even our markets of 13% down in Nifty, and the IT was a major backbone. Every time there is market crash that happens, but this time that didn't help in 2022. So S&P 500 is 14.5% down. So all the US markets were substantial down. S&P 500 is a broader index. Even that was done a very good correction at this point in time. 14.5, 15% is very good corrections, and below 20 it will become not correction anymore. It will be crack. That has not happened, but although it has happened in the Nasdaq. So let's get back, and so the FTSE, the UK index is also 0.75% down, 7.5% down in CAC. France, German 11% down, Hansek is 17% down, Nikkei is 3.5%. So all global indices were smart by Indian market. Look at the currency performance. Dollar index is short of 7%. Right, 7%. 7% is huge. Right, so it's near 105 on our index. Although it is not directly correlated, the rupee has weakened 11% depreciated. Like USD INR currency pair, if you see 11% of up moves happened in 2022. So the rupee has weakened is the biggest bad thing that India has not been able to manage till now. Right. Obviously that will happen because of various macroeconomic factors. But the markets have outperformed. Rupee is still a worry, where the rupee is at 82.7 kind of levels. For Indian rupee has depreciated, and US dollar index has shot up. Crude commodities, crude and gold. Crude oil has 7% down in 2022. It shot up to 120 a barrel at the COVID crisis time. Then it eased off in 2022 after the COVID crisis of 2 years, and it was 7% down. It cooled off a little bit. So that made things better for in some way. Although globally the crude is expected to short back because of the fact that the Russian pullback of the oil supply and things like that, right? So crude can spike up, but as long as 2022 crude supply has actually cooled off, is a good thing that happened, right? Gold is the hedging instrument, and it's 1.4% up, so it was kind of flat moves on the gold side. So market crashes, then that's when the gold would start to move. So 1.4% has happened in the recent correction. Otherwise, gold was in the negatives most of the 2022. Now, just to summarize, look at this charts of Nifty the last 20 years from the 2000. It has been making reasonable corrections of 10 to 15%, and then, but on a long term, it has been steadily rising up and rising up. That's how emerging markets and growing economies like ours are supposed to do, and that's how it will do. Even though the corrections would give the impression that it's very risky and you'll lose everything, but actually, the biggest crisis of the COVID. It happened. It did fall down to 7,500 levels from the top at 12,000, but it eventually, now it's heading towards 20,000. That whereas 12,000 and 20,000. So that's the kind of up move that happens. The corrections are always there, part of it. So 2022 India has outperformed. No doubt about that from all the data that we had seen. Inflation have fed rate hikes and all things are happening. So there is being curtailed. Inflation would eventually get tamed and things will get back to normal. But there will be interim corrections and global recessions and all that will be there in 2022 mid something, and then that's what my outlook is. So it's likely to move up to 19,500, making another new higher high. But considering corrections, it won't go below the 15,000 or 16,000. Not less than 16,000. It's not really less likely that it goes below the 16,000 or the previous swing level nearby that 15,800, 15,600 or something. That level, it won't go below that for sure, right? That's what I look forward. And 19,500, maybe too less a target that time I put it. Sometimes it could touch 20,000 also, but 19,000 for sure, definitely. That's the way the market is going. So interim corrections would be the buying opportunities, and that will be the investment opportunities that we can look forward, right? Having said all that, nothing is predictable in the market. Who would have thought that market would crash 20% plus in the COVID times when we have such huge pullbacks? Who would have thought of Russian war, and you would have thought of surgical strikes and things like that. So everything is unpredictable. There will be black swan events we can never predict, but ultimately in the longer term, the market may be heading higher. And this year was phenomenal strength that's shown in the retail market. It's the domestic institutions, which means the retail money, the mutual fund money, that helps the market even when the institutions were pulling out such big. If the domestic institution money was not there, the market would have crashed. Right? So that clearly shows the confidence of retailers in the market. Right? So that's a wrap up of 2023 market outlook, summarizing all that we had looked at in different factors. I hope this helped you to get some clarity on how the market did in the last 1 year. Right. So thanks for watching. Happy trading, happy learning, happy investing. Bye bye.